Hi there, welcome to Nepi Invest. One of the main reasons I started this video channel was to share ideas with you on the hope that I could give some inspiration to you to do further research on a company you do like. Now, just because I am sharing ideas with you doesn't mean some of these ideas or some of these companies are the sort of companies I will personally invest in. And that is definitely true for the company I'll be featuring in today's video, Clean Seas Seafood. Now, there are quite a few reasons why more than likely I won't invest in this company. And I have been tracking the performance of Clean Seas Seafood over the past 9 years. And to be honest with you, the financial performance of this company has been quite underwhelming during that time period. Continually operational cash flow negative almost every single half year and every single full year. But sometimes companies can turn things around. And there is potential that Clean Seas Seafood has done exactly that based off their operational cash flow for the first half of financial year 22, which looks like it will come in at over $6 million. We'll have confirmation of that number when they release their half-yearly results in February. But we do know the number simply because they did release their quarterly report for December a few days ago from when I'm doing this video. And in fact, in the quarterly report, we do know and we can see the state of their cash flow based off that report, and it is just over $6 million. So before we look at the latest Appendix 4C that Clean Seas did release, just a few facts in regards to this company. What exactly do they do? Clean Seas Seafood is a vertically integrated farmer, probably the best way to put it, of yellowtail kingfish. Yellowtail kingfish is a fish you find, it's indigenous to Australia, so you find it between southern Queensland and West Australia, so in southern waters. And I think that is an attractive thing for Clean Seas, that they do farm a fish that is indigenous to Australian waters. So I'm not sure how much competitors they do have in this area. And the reason I say they are vertically integrated is because they are fully in the process of growing the yellowtail kingfish, from fertilizing process, the egg, all the way to selling the yellowtail kingfish to retail and restaurants. So they're in it from that fertilizing point, as I mentioned before, to the hatchling process, to the fingerlings process. And in that process, or those two processes, the fish are grown on land in water containers, that sort of thing. And there are people looking after the fish. They get fed a really good diet. And when they turn 75 days old, they get a helicopter ride, a free helicopter ride to the sea farm, and that sea farm is in Spencer Gulf of South Australia. They mention here it's the crystal clear waters of Spencer Gulf. Now, then the fish grow for between about 14 and 24 months. After 13 to 15 months, when they get to about 3 to 3.5 kilograms, they might be harvested and sold to retail. And some of the fish are kept on growing until they get to about 4 to 4.5 kilograms. That's about 24 months. And those fish are sold to restaurants. Now, during this video, I'm going to talk about some bear cases and some bull cases for Clean Seas. And one of the reasons I probably won't invest in Clean Seas is simply because they are a commodity, or they're selling a commodity. So even though most people think of commodities as gold, silver, materials or minerals, or maybe even wheat, corn, fish is also a commodity. And the way to look at commodity is the price of the commodity is all dependent on demand and supply. And if you look at the demand of yellowtail kingfish right now, there is actually increasing demand apparently, and the price of yellowtail kingfish is increasing. And that information is found in the commentary from Clean Seas' most recent Appendix 4C. And when the price of a commodity goes up, that increases the potential you'll see more competitors come onto scene to take advantage of the increased price in the commodity. Now, it might take a while for any competitors to pop up, so there is a period of time here where Clean Seas Seafood can take advantage of the increase in price of yellowtail kingfish. But there will come a point in time when there's going to be an increased supply of this fish onto the market, and that might put pressure on the price of the commodity. So the best way to look at Clean Seas Seafood is they are a price taker, not a price maker. They have no control over the price they sell their fish for. Now, just a few facts in regards to Clean Seas Seafood. This company has been around for a while. They were founded in September 2000. It took them 5 years to list on the ASX. That was December 2005. That means this company has been on the ASX for just over 16 years. And to be honest with you, they haven't been that successful during that 16-year period. But the past means nothing. Just because they haven't had much success in that period doesn't mean they won't have success in the future. The current CEO, he's been in that role for about 2 years, Robert Granton, and there is a possibility that he's the reason why this company might be turning things around. He only has a 0.3% holding in the company. And then if you look at the market cap or the value of Clean Seas right now, $103 million, that's at a share price of 62 cents. Now, the market cap or the value of this company has almost tripled in the past 5 years. But even though the value of this company has tripled in the past 3 years, the share price has actually decreased. And I'll talk about the reason why that has happened in the next slide. And the ticker code for Clean Seas is CSS. Now I just want to look at some of the financial numbers for Clean Seas. And in this slide, we're going to look at 2021 numbers and compare it to 5 years ago, 2016. And when I'm comparing financial numbers for a company, what I want to see is three things. I want to see revenue growing over that time period. I want to see the operational cash flow of the company improving. In fact, I want to see the company at least get to or become operational cash flow positive during that period of time. And if they do, I also want to see the company becoming free cash flow positive. So as we look at Clean Seas' financial performance over the past 5 years, the revenue does get a tick. We have seen revenue grow. In fact, it's grown from $30 million to $48.5 million. Now, if we have a look at the operational cash flow, this is where we do see a fair bit of red flags pop up for this company. And in fact, in the most recent year, 2021, Clean Seas was operational cash flow negative by $9.8 million. And this has been a problem for this company over the past 10 years. They have bled a lot of cash. And I won't even talk about the profitability of this company because in 2021, they were loss-making by $32 million. More than likely, there were some one-offs in there to affect that number to make it a little bit higher. But let's go back to the operational cash flow. When a company is continually and habitually operational cash flow negative, there is one thing that company is going to do time and time again, and that is raise more capital, which means the shares on issue of the company will increase over time. And for Clean Seas, that has definitely happened over the past 5 years. In fact, shares on issue have tripled during that period, increasing from 55 million to 165 million. There is a possibility here that Clean Seas did go through a share consolidation. So even though it says here 55 million shares on issue in 2016, that could have been considerably higher. But the main thing here, it's all relative. And over the past 5 years, the amount of shares on issue have tripled. And that is a byproduct of a company being operational cash flow positive on a consistent basis. And that has an effect when you compare the market cap of the company to the share price of the company. So the value of Clean Seas has almost tripled over the past 5 years, increasing from 38 million to 103 million. And if you looked at that in isolation, you would think shareholders have done well over that period. But the share price of Clean Seas has actually dropped. It has fallen from 68 cents to 62 cents. And that's all because of the dilutive effect of capital raisings. The company does have about $10 million of net cash. And over the past year, they have paid back some loans. So that is a good thing that management have decided to do over the past year or so. Now let's have a look at a bull and, well, a very slight bull case and a bear case for Clean Seas, looking at the financial performance of the company over the past 10 years, focusing on revenue and operational cash flow. So on the top we have revenue, and on the bottom we have the operational cash flow. What I want to see here is revenue growing through time. And it is safe to say that since 2014, revenue has grown for Clean Seas, increasing from 10.4 million in 2014 to 48.4 million. Now, I should say here, these are looking at full-year numbers, not half-year numbers or even quarterly numbers. So we have seen revenue quadruple in the past 7 years. But if you look at the last 4 years, revenue has stayed within the range between 40 million and 50 million. So I'd like to see some better growth in revenue over the next few years for Clean Seas. So that's a slight bull case for this company, that we have seen revenue grow over the past 7 years. But to the bear case, operational cash flow of the company. And in fact, this company has been continually operational cash flow negative on a yearly basis over this whole 10-year period. Their best year was 2020, when they were negative by only about 30,000, but the two worst full years were 2 of the last 3 years, where they are operational cash flow negative by nearly $10 million. Now, I broke this down into half-year increments just to see if there are any half years where this company was operational cash flow positive. And there were 4 half years out of 20 that they were operational cash flow positive. So even though they were operational cash flow, or will be operational cash flow positive for the first half of financial year 22, we have seen this in the past. But the one positive thing is, in the past, when they were operational cash flow positive in a half year, it was by a small amount, like $1 million or even less than $1 million. And we will see this company operational cash flow positive by over $6 million for this first half of financial year 22, which is a significant improvement from what we have seen in the past from this company. Now let's have a look at 2 Appendix 4Cs for Clean Seas. And what I do here is go back 1 year ago and look at the cash flow for the company 1 year ago and compare it to the most recent cash flow. And the reason I do that is just to get rid of any seasonality in the company. I'm not sure if there is any seasonality in Clean Seas, but that's the reason I do that. I just want to compare apples with apples, not apples to potential oranges. And if we go back 1 year ago, receipts to customers for Clean Seas was 11.3 million, and they were nearly operational cash flow positive. They're actually only negative by 127,000, which might mean they didn't lose much cash. But when you look at the cash on hand at the start of the quarter and compare it to the end of the quarter, this company did lose $10.2 million. And you might be saying, how did that happen if they're only operational cash flow negative by 127,000? Well, the reason for that is they did repay a loan, $9.2 million of borrowings. They also spent $883,000 on capital expenditure, which is property, plants, and equipment. And one of the reasons I always look at the operational cash flow and then also look at the free cash flow is for this exact reason. So even though Clean Seas was operational cash flow negative by a small amount, 127,000, they were actually free cash flow negative by almost $1 million. So sometimes the amount of capital expenditure can make a difference. Now let's have a look at the most recent Appendix 4C for Clean Seas. And this was a really good report, significant growth in terms of cash receipts. And even though we saw significant growth in cash receipts, we didn't see significant growth in the cost base. So receipts grew by $6 million. So even though receipts grew by $6 million, product manufacturing operating costs only grew by $800,000. Staff's costs actually went down $300,000, so that should be down, not up. And feed actually grew by $1.4 million. So it seems like the fish have had a better life in the past year or so. So the cost didn't increase by that much, which means that increase in receipts went to the bottom line. And for this particular quarter, Clean Seas was operational cash flow positive by $3.9 million. Now, cash on hand actually did fall during the quarter from $15.9 million to $14.6 million. Again, they repaid some borrowings, $4.1 million, and they spent $1.4 million on capital expenditure. But if you take away that capital expenditure from the cash flow from operations, this company was $2.5 million free cash flow positive. So things are looking up based off the most recent quarter from Clean Seas Seafood. The most important thing moving forward is, can they continue this momentum moving forward? maybe there are some reasons why they did really well in this quarter. Potentially they were selling their yellowtail kingfish for way higher prices than they were before. And there was some talk of that in the commentary of in this particular quarterly report. So things are looking up for this company. Now let's have a look at the cash receipts history for Clean Seas. And this is a bit of a bull case for this company, because one of the things I do look for as I track companies who release Appendix 4Cs is a growth in receipts over time. I want to see a company growing their revenue, and then of course if they are growing their revenue, I don't want to see costs growing at a greater rate. And there are some companies out there that are exactly doing that. They will talk about how they're growing revenue or their cash receipts, but at the same time costs are increasing at a greater rate. I won't talk about exactly what companies those are, but keep an eye on those companies, because I think we will see that those companies' share price come under pressure. And in fact, in the United States, those exact companies are coming under pressure and have been under pressure for the past 6 months to 1 year. Anyway, for Clean Seas Seafood, we have seen really good growth in their receipts since 2013, the September quarter of that year, when I first started tracking this company. In fact, receipts have grown from 1.9 million to 17.4 million. We did see a massive hit, or this company did see a massive hit during the COVID-19 period back in the June quarter of 2020. Receipts fell from 12.4 million to 5.7 million, but we have seen really good growth over the past 5 quarters. Receipts have grown from 8.8 million or 5.7 million from the bottom here all the way up to 17.4 million. And if we look at the growth in receipts the past 3 quarters, it's gone from 12 million to 17.4 million. My main question moving forward for Clean Seas is, will this momentum continue moving forward? Now, I did read in their commentary, there is a limit to how much yellowtail kingfish they can harvest or grow. So that is a problem moving forward for this company in the future, unless they get more permits or whatever they need, unless regulations change, unless they get more farming area, that sort of thing. So keep that in the back of your mind, that there is a limit to how much yellowtail kingfish they actually can grow and sell. Now let's have a look at the share price performance of Clean Seas over the past 8 or 9 years since I've been following this company. And to be honest with you, just like the underwhelming financial performance of the company, the share price has likewise been quite underwhelming. We've seen some highs where the sentiment of the company has been quite strong. In fact, between 2013 and the end of 2014, we did see a share price rise from about 25 cents to $1.62. And keeping in mind, I think there was a share consolidation of this company. But we've seen the share price high over the past 9 years in that $1.50 to $1.60 range, and the lows have been around about 30 cents to about 40 cents, which we did see back in 2013. And then again during the COVID-19 financial panic. But the share price has been struggling lately. And when I did see the release of this quarterly report, I thought we might see a potential breakout in the share price as the market gets a little bit excited about this company being operational cash flow positive by $6 million for the half year and over $3 million for the quarter. So let's have a look at the daily chart to see if there is a potential breakout going on right now. And as we focus on the daily chart, which goes back to December 2020, the share price reached a high of about 92 cents. Really nothing happening with Clean Seas over the past year. In fact, the share price has gone down as low as 51.5 cents, which seems like a really good support level. You can see the share price hitting that 51.5 level about 5 times over a 5-month period. So more times the share price hits a support level, the more powerful that support level becomes, which also means the share price will have a hard time falling through that. But if it does fall through that, that would be a bearish move. But the share price right now is nowhere near that support level. Now, we did see some good reaction from the market in terms of share price movement on release of the Appendix 4C. Share price did rise from about 62 cents to 66 cents, so a nice 8 to 9% rise in the share price. But the only thing I didn't like was the volume. I would have preferred higher volume, and when we see higher volume with share price increasing, that is telling us the market is excited about the whatever's driving the share price higher. So at this point, the market wasn't that excited, or we could say probably it was subdued. So even the share price did rise, there wasn't a lot of volume, and that could be trouble moving forward for Clean Seas, because we are moving into a resistance level right now, getting close to that previous high we saw in November. Share price reached a high of 69 cents. If the share price can move above 69 cents, that will be a bullish move moving forward from Clean Seas. But I think for it to do that, we need some more volume coming in. We need the market to be more excited about this company. And we really haven't seen that overwhelming excitement just yet in Clean Seas. That is all I have for this video on Clean Seas Seafood. Now, the operational cash flow, which I actually didn't show you, I'll show you that now. I forgot to mention this when we looked at the most recent Appendix 4C for Clean Seas. When you look at the statement of cash flows in the Appendix 4Cs, there are 3 columns. The first column is just what everything is, what the numbers are. The second column is the current quarter numbers. And then the last column is the year-to-date numbers. And for Clean Seas, the year-to-date numbers is for the last 6 months. And if we go to the bottom, where it shows you whether the company's operational cash flow negative or positive, for Clean Seas, we see that they were operational cash flow positive for the first half by $6.0 million. So again, that's all I have for this video on Clean Seas, and they're really good first half of financial year 22, operational cash flow positive by $6 million. If you do have any thoughts about this company, I'd love to know them, so leave them in the comments section of this video. There is a chance I won't be able to reply to your comments because I am quite busy right now. Anyway, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.